people don't understand, a lot of people, the difference between deficit and debt. The debt is the accumulated deficits year after year after year. So if the deficit is going to be $2 trillion, just to not have a deficit and have no change in the national debt, we would have to revalue gold to roughly, if it was $3,300 to gain that $1 trillion, then we'd have to revalue it to $6,600 just to offset. And they're talking about trying to reduce the debt with this. And so they're trapped. There's going to be some.
So getting back to our 5 predictions, will the London precious metals market be exposed? I mean, depending on your standard, they already have been. It's sort of hiding in plain sight.
Well,
who knows if it'll take another form.
They were running out of gold a while back, and then gold flows started happening from the United States. It's interesting, if you look at since COVID, the way that world gold flows just suddenly like switch, like it's an emergency, and it was. The COMEX was going to have a force majeure, basically, if they didn't get refilled, and a whole bunch of gold flowed out of England, and then the Swiss refineries all stopped shipping to anybody else on the planet and shipped only to the United States for a few months. We wrote about it in our book, The Great Gold and Silver Rush of the 21st Century. But then, recently, the LBMA was running very, very low on silver. And all of these exchanges are just nothing but fractional reserve schemes. The number of contracts that exist, the ounces of paper, gold and silver, which sets the spot price, can be so many multiples of the actual physical that's there. And the LBMA became very dangerously low on silver. They became low on gold back during COVID, but they really became low on silver recently. So anyway, let's move on.
During the pandemic, gold reserves inside London and Switzerland reached critically low levels, prompting frantic global restocking. Metals flowed heavily toward the United States, suggesting a strategic rescue of delivery hubs like COMEX, which at the time faced risk of defaulting on physical settlements. Swiss refineries prioritized U.S. shipments for months, an extraordinary divergence from historical patterns. Decades-long incentive systems flipped almost overnight, reflecting systemic stress rather than typical trade arbitrage. It marked one of the largest coordinated physical refills of precious metals infrastructure in modern history, proving how delicate pricing anchors become when contractual demand meets real scarcity.
Yeah, the next one is the COMEX depository warehouse gold stocks. So basically, this is a chart we put in the book, Mike. This is in chapter 9, which was called Somebody Big is Getting Ready for Something Really Big.
Yeah. Now this goes back a lot further. Okay. So they basically saved the COMEX from a force majeure, and they stopped gold from like just leaping to $5,000, $6,000, $10,000 an ounce by having all these gold inflows from the Swiss refineries and from London, and even from China, which had never happened before. So it's like the whole world was coming to the rescue of the COMEX to keep the fraud of their fractional reserve scheme from being exposed, which would have caused gold to just suddenly leap into the stratosphere. And what was gold's price back in 2019 and early 2020? Was it still below 2,000?
Yeah, you can see... Yeah, right here. This is the 2000 line. So it just peaked above 2000 barely.
Well, that's with those big inflows. But before the inflows happened, we were down at 1,700, 1,500. Yeah, amazing.
Yep. And so you're right. There was a force majeure that was prevented with all this gold. And now we have another spike similar to the COVID spike where we're up at higher levels. So
they're getting ready for something.
Gold and silver exchanges behave more like credit markets than commodities markets. Futures and unallocated contracts create synthetic ounces that set global spot prices, often many times greater than physically held metal. This disconnect is the core vulnerability. Prices can surge even while vault inventories shrink, and contracts can multiply without adding real supply. Analysts describe it as crowded trades revolving around a single delivery base. When inventories fall too low, exchanges adjust delivery ratios, lease commitments, and contract multipliers to maintain order. The system survives not through transparency, but through periodic balance sheet re-engineering that prevents settlement failure rather than fixing root supply.
So getting back to our prediction, is the U.S. government quietly accumulating gold? I mean, what we just looked at, it's not government gold, right? But we're seeing gold flow into the United States, which is unusual. That's kind of the point.
Right.
So
now, you could, and maybe we should do this for a future video, if we get the raw data from Nick Laird of those gold flows, and then deduct what actually went onto the COMEX. Any excess that did not end up in COMEX vaults could have been accumulated by the government. So it'd be very interesting to create that.
It would be. And just for anyone curious, if you look at any of the official numbers for gold holdings by the New York Fed or Fort Knox or just any of these places, they haven't changed. They're all flat. And so part of the prediction here is that it's happening secretly. Maybe they're replenishing old amounts that aren't there. So it's very hard to get data about those exact numbers, but it's possible that this is happening.
And all of the gold that the U.S. does have has been pledged to the Federal Reserve and is used to back Federal Reserve notes at $42.22222 on into infinity. 42 2/9 dollars. Central banks lease gold, period. This is a fact. And if that gold is all leased and they want to do something with it, they would have to unwind a bunch of those leases. And if they unwind those leases, it causes the price to rise. So this is could be part of what is driving the price. But
exactly.
So is the government accumulating gold? It wouldn't surprise me because China has been doing it secretly. They report a certain amount, but it is suspected that the actual amount is more than double what they're reporting.
Exactly. And remember the golden rule, he who has the gold makes the rules.
Right.
So I do think that's happening. All right, number 3, the United States is executing a new bilateral soft devaluation strategy, a decentralized version of the Plaza Accord. So let's see what that looks like. So back in March, so kind of old at this point, there's been talk about a possible meeting in Mar-a-Lago for a new currency deal, sort of maybe a new monetary system, or at least as a precursor, maybe just some globally cooperative moves to cause the value of different currencies to fluctuate. So what happened in the Plaza Accord? Well, that was back in 1985. And finance ministers from France, Germany, Japan, the UK, and the US came to an agreement in the Plaza Hotel in New York City to intentionally devalue the US dollar. In the 5 years leading up to the Plaza Accord, the US dollar had doubled in value. So double in value in 5 years, threatening to upend global trade and destabilize the international financial system. So today we could do something similar. That's kind of the idea here. So just to show you what that looked like in a chart, the DXY is here in green. So we can see the dollar relative to a basket of foreign currencies basically doubled in value from roughly 80 to 160 in 5 years. So that's a lot of value gained in a short period of time. And that basically disincentivized manufacturing, and the US had to do something about it. So they basically encouraged all these other countries to allow the dollar to fall in value.
In the 1980s, coordinated currency controls triggered a 2/3 fall in gold as the US dollar soared. Today, the environment is inverted. Most global currencies are held flat or strategically weakened, while gold has tripled in price since 2020, breaking above $4,500 per ounce in 2025. Unlike the setup preceding the 1985 Plaza Accord, this isn't a bilateral currency strategy. It's competitive soft devaluation, where nations pursue export resilience through domestic monetary expansion. Inflation now becomes the default geopolitical toolkit. Investors mistaking high prices for cycle peaks forget the larger game. Repricing national reserves and restoring delivery markets has shifted from currency diplomacy to raw liquidity acceleration.
And so, Mike, do you want to jump in here?
Well, I remember this pretty well because sometime in 84 or early 85, my father had a heart attack, and he was hospitalized to have a quadruple bypass surgery. And it was just before he was supposed to leave on a trip where everything was paid for. All the airline tickets, the hotels, everything was booked, ready to go. And he was supposed to tour several different countries. And our dollar was so strong that it was very profitable to be an importer. And so he sent me in his place. Now, I was young then and really didn't know what I was doing, but it was interesting. I was in the Netherlands first, and I bought a full-length pigskin suede trench coat, beautiful trench coat that, if you bought it in New York City, would have cost at least $1,000. I bought it for $27. I bought these beautiful ties for like $5 a piece, $3 a piece in the Netherlands. I couldn't believe how inexpensive things were. But there was a mirror image of that for anybody traveling to the United States from abroad. Everything was astronomically expensive, including our exports to other countries. And so this was needed, and sort of countries, it had gotten so that their goods were so cheap that compared to ours, that they wanted things to be devalued, but the dollar to be devalued. So this was a cooperative effort where they sold their currencies and they bought the dollar, and we sold the dollar and bought their currencies. And it's all just, it's a balance sheet accounting gimmick, basically, a trick to adjust this. But what is interesting is that they started 5 months before the Plaza Accord. So actually, they had a game plan, they started executing it, and then they signed the documents. Do you agree?
Yeah, exactly. So we can see this was a sharp upward trajectory in the green line, and then it just turns around and goes the other way. So definitely that's when they started, but then they didn't actually get together and sign the paperwork and make it official until this second line here. So yeah, there was a gap here. So yeah, okay. Definitely a coordinated effort. It's not a conspiracy theory or anything like that. This is known fact. This is historical fact. So this is what happened. However, this isn't really the setup that we're in right now. So you can see that the dollar doubled in 5 years, and the price of gold, by the way, fell by 2/3 because the dollar was so strong. And here's where we are now. The 5 years leading up to today, the dollar has been basically flat. So it hasn't been doubling in power relative to foreign currencies. It's flat. And gold hasn't been selling off by 2/3. It's actually basically tripled. So the setup is not the same, and the incentives are not the same. So even if the US does want to devalue the dollar and try to incentivize onshoring of manufacturing, other countries aren't on board with that. They want to do the same thing for their own countries. So the situation we're in now is basically a race to the bottom, where everyone wants to devalue their own currencies, not necessarily.
And that reason in your list of 5 predictions, the reason said that we're trying to reach a bilateral accord to do this, which the last one was. We were selling our currency and buying other currencies, and the other governments were selling our currency and buying their own currency to make their currencies go up and the U.S. dollar go down. But this isn't going to be a bilateral soft devaluation strategy. The only way it's going to happen is unilateral. The U.S. will just make the decision to print. And print means inflation, which means gold at this bull market isn't done. People are going, $4,500 an ounce. Gold is really expensive. I missed it. No, you didn't. This is the beginning. Sorry.
I agree.
Right. Because it's when they start when they start typing more currency into existence, because they don't print anymore. They type. And it's going to be massive. And they do want a weaker dollar. But none of the other countries want a weaker dollar. The other countries want to keep their currency weak. So yes, it's a race to the bottom. If we start printing, they will start printing. So it's whoever is able to print the most as a percentage of their currency supply that will be able to maintain their exports.
Some governments have debated repricing gold reserves on national balance sheets to unlock fiscal headroom without raising taxes or debt issuance. While theoretically dramatic, any realistic repricing would likely offset less than 1 year of deficits given current debt trends exceeding $2 trillion annually. Analysts also warn that using reserve repricing to retire debt risks destroying currency base needed to repay bonds, triggering unintended shocks across liquidity and inflation. Economists emphasize the difference between deficits, annual budget gaps, and debt, cumulative deficits spanning decades. Revaluation offers perception of financial strength, but it doesn't erase obligations. At best, it buys time before markets determine credibility.
So getting back to number 3 here, the U.S. might be trying to do it, but they're not likely to get cooperation from other countries.
Right.
So it's unlikely that's going to happen. So number 4, the U.S. will revalue its gold holdings to a higher price level to support fiscal objectives. And so this idea came because the Fed actually published an article on their website back in August, and everyone picked it up, and there's all kinds of speculation about it. So basically, with public debt at high levels, some governments have begun to explore financing additional expenditures without raising tax while also not increasing public debt outstanding. Sounds great. One possibility is using proceeds from valuation gains on gold reserves, as has been floated in the US and Belgium, coincidentally. So what that would mean is you raise the statutory price of gold from 42.22 per ounce to current market prices, which were around 3,300 at the time, 4,000 or maybe even 5,000 by the time they decide to do it.
I want to point out something. They were 3,300 at the time, and this is dated August 1st. How fast we've gone to 4,500 from 3,300. It's quite amazing. And, even here, we had gone from 2,000 to 3,300 very quickly.
Yeah, just to talk about how do they do that? Is this created out of thin air? I mean, it all is created out of thin air. But anyways, here's a stylized example of what would happen on the balance sheet. So if you revalue it from the historic cost, you increase the asset of the gold reserve by whatever the difference is in price multiplied by how many ounces you have. And then the central government account would go up by an equal number. Okay, so the math stays the same. And if the central government were to use the proceeds, what would happen is the gold revaluation account would drop by a certain amount, and the central government account would just be credited an equal amount. So that's what would happen there. It's really just a balance sheet trickeration, and then the Treasury would get to spend roughly $1 trillion at today's price of gold. If they do it at a higher rate, they could potentially get more than that.
Yeah, it's a balance sheet trick, and the operative word here is trick, because they've been doing this voodoo scam. This is the monetary system. This is the way our monetary system works, is this balance sheet stuff that sort of hides what is actually happening. The actual purchasing power, if they increase the currency supply, is going to come at the expense of inflation. So the purchasing power is stolen from the public and given to the government to spend by doing it. There's a lag time. But also, we did the calculations before, and it required this doesn't even cover the deficit, because we're going to have a deficit of a couple $2 trillion. That revaluation that they were talking about from 42.22 up to, which you may as well, it's close enough to zero to just say $0 to $3,300. And that is like finding $1 trillion suddenly. So you find this magic $1 trillion that comes from nowhere. You type these new numbers into existence on your balance sheet by calling gold a higher price. But there's a $2 trillion deficit that year. So it doesn't even cover the deficit. They were talking about reducing the debt. No, it's not going to reduce the debt. So you go from 3,300 to 6,600. Now you got 2 trillion, and that offsets. So if they revalued to 6,600, that'll just offset the budget deficit, which would be the increase in national debt at the end of this year, not next year and the year after. And so you and I calculated this, and I think we came out with something like $142,000 or $147,000 an ounce to wipe out the national debt. And that would upset the entire global economy. Plus, if you try and pay down the debt and pay it off, you're destroying. So this currency would come into existence, and then you're destroying the dollars, the principal that goes to pay back the treasury bonds. And so, I don't know if this would be hugely deflationary, inflationary, but what it will create, I can guarantee, is a roller coaster that will hit everybody. It'll just blindside everybody. Nobody will be able to predict what's going on. And it's all a bad idea. And you know what? It's too late. We really should have been using gold and silver as money, as the Constitution mandates for this entire time. We've been, the rug has been pulled out from under us. The wool has been pulled over our eyes. We have been tricked. All this sleight of hand, balance sheet, accounting gimmickry is how this is concealed, that it's just a wealth transfer that's going on. So anyway.
Exactly. And to your point, any realistic number that they might pick, like the market price to revalue it, it's not even the deficit for 1 year. It's right. And then you're out of options. Then you you can't revalue it again.
People don't understand, a lot of people, the difference between deficit and debt. The debt is the accumulated deficits year after year after year. So if the deficit is going to be $2 trillion, just to not have a deficit and have no change in the national debt, we would have to revalue gold to roughly, if it was $3,300 to gain that $1 trillion, then we'd have to revalue it to $6,600 just to offset. And they're talking about trying to reduce the debt with this. And so they're trapped. There's going to be some horrific event eventually, and the free market will be trying to figure this out. And it will be better than all of the politicians and the people that think they're masters of the economic universe that run the Federal Reserve and so on, rushing in to save us. And every time they do something, it only makes the problems worse.
A strategy that worked for decades eventually becomes a trap when conditions reverse. The global monetary system increasingly relies on discretionary liquidity injections, balance sheet adjustments, and inflation-driven stimulus. Every intervention aimed at calming markets risks amplifying future instability by delaying price discovery. The next decade will likely look different, where the leadership shifts from equities and credit toward tangible assets like commodities and metals, driven by inflation pressure rather than currency coordination. The assumption that markets always self-rescue through policy support ignores history's real lesson. Stability returns not when control succeeds, but when the free market forces truth into the price.